Good morning, all. Welcome to the Swansea Local Government Pension Fund Committee on the 26th of February 2026. First item on the agenda is apologies for absence. Jeremy, have we got any apologies?
Yeah, thank you, Chair. Apology from Councillor Phil Rogers. Also, Councillor Patience Bentu will be late, so if she doesn't manage to attend, I'll record her apologies. Thank you.
Thank you very much. Second item is disclosures of personal or prejudicial interests. Are there any? Phil. Oh, Phil, thank you. Phil online. I'm receiving a pension from the Local Government Pension Fund. Any others? Any online? No.
Yeah, Phil Downing.
Phil Downing. Thank you, Phil.
Yeah, my brother's a member of the pension fund, Chair, as usual.
Thank you.
Sam Richard.
Sam?
Yeah, thank you, Chair. I'm also a member of the pension fund.
Thank you, Sam.
And Will.
Will?
Morning. Yeah, member of the fund. I do apologise, not feeling very well today, and also my computer's not working. I'm on my phone, so I'm trying to get on the computer. So if you see me touching the screen, you know what I'm doing.
Thank you, Will. Thank you, Will. Officers?
Yeah, myself, Chair, member of the pension fund.
Debs?
Yes, I think it'll be a block.
A block.
A
Thank
declaration
you,
for
Deb.
all
There we
officers. Yeah,
Thank
who
you.
are members of the
That's
pension
very
fund.
Yeah, okay. Doing all right? Thank you. Moving on then, the next item on the agenda is a report of the independent consultants from Hymans, which I believe are Mike Johnson and Chris O'Brien. And this report is the City and County Swansea Pension Fund 2025 Investment Strategy Review. Can I ask Jeff to come in here?
Thanks, Chairman. I'm just going to give some introductory comments and a bit of background to introduce the paper by Mike and Chris. It's quite a comprehensive and complex piece of work commissioned by the committee following, as is custom and practice, the triennial evaluation which took place in 2025. That's the appropriate time to review the investment strategy, whether it's still fit for purpose or whether it needs to evolve and change and reflect not only the demographics and the changes experienced by the fund and the funding level of the fund itself, but also taking into account the opportunities out there in the economic landscape and the political landscape and all the factors potentially affecting the investment strategy that the pension fund shall implement for the next 3 years. Obviously, the results of the previous investment review following 2022 and 2019 have been implemented, have been largely successful, and this fund has experienced the fruits of those investment strategy reviews in the interim years. The paper that Mike and Chris have worked on and are presenting before you today for approval is an evolution of that current strategy and looks to build on the good work that's been achieved in the interim and should safeguard and strengthen the fund to be able to move forward for the next 3 years until the next valuation. Hand over to Mike and Chris.
Thank you, Jeff.
Yeah, thanks, Jeff. So as Jeff said, this is a triennial piece of work, and we had the fund valuation in 2025, and that the results of that were that we're in a favourable funding position with 122% funded at the valuation date, and that puts us in a strong position to be able to think about the return we're targeting within the investment strategy and the level of risk that we have within the investment strategy. And we think about 3 key building blocks within that. We've got a growth portfolio, which is largely equities. We've got an income portfolio, which is infrastructure and it's property and it's things that are generating an income for us. And then we've got protection assets, which are things that when other markets are falling in value, hopefully these things will be a bit more stable and provide us with some ballast and protection from more difficult market conditions. And so there are two elements to the strategy review that we've looked at. Firstly, the overall structure, the balance between that growth, income and protection portfolios. What should that look like, and what risk and return characteristics might that deliver for us? And secondly, within each of those growth, income and protection buckets, how should we allocate between the different underlying asset classes? And we're obviously not starting with a blank sheet of paper. We have the assets that we currently hold, and throwing everything up in the air and starting again isn't appropriate, not least because it would be very costly, but also because what we're doing as we stand is still a sensible thing to be doing. So this is very much a piece of work which is looking to evolve what we're doing and make slight adjustments to it to put us in a better place as we move forward. The second thing that we've been incredibly mindful of as we've put this piece of work together is the Fit for the Future consultation that is out there, and the fact that with effect from the 1st of April, we're going to be required to be taking advice from WPP, the pool, in terms of how we're structuring the investment strategy. We still don't know exactly what that's going to look like or feel like. A lot of moving parts, a lot of activity going on in the wider local government pension scheme sector. But we know that things are going to be changing, and we know that there are certain buckets for asset class buckets that are being defined, and that all of the pools, including WPP, are going to be using, and that you will be able to use. I think for Swansea and for WPP, we are in a pretty strong position. We've pooled a substantial amount of our assets to WPP already. There are elements of this piece of work where we will be recommending some reallocations away from assets that are not pooled towards WPP pooled products, and that is absolutely in line with the intention of the Fit for the Future consultation and the direction of travel for the local government pension funds. There is a lot of detail in this paper. I'm going to go through it. Well, Chris and I are going to go through it. We're going to take some time going through it, but I'm going to give you the headline messages, and then I'm going to let Chris go through some of the detail within the growth, income and protection portfolios. Our current allocation has 70% of our assets in growth, and of that, 61% is in equity and 9% is in private equity. So substantially all of that growth asset is in equity, 61% in public equity and 9% in private equity. There isn't anything we can really do about that private equity allocation. That is 9%, and it will, you could sell it, but you'd sell it at a significant discount. You don't want to sell it. It's serving a purpose for us. The 61% in public equities, our current long-term target is to reduce that 61% to 48%. So we've maintained an overweight position to public equities for the last few years, and that's been deliberate. We have trimmed it slightly, but that has also served us incredibly well. We've seen really strong equity markets, and they continue to be at record highs. I mean, the FTSE 100 in the UK, not to pick out the UK specifically, but yesterday it hit another all-time high at 10,800. So yes, there's been some rotation away from US markets, but overall global equity markets remain very strong, and they are at record highs. That to me says we've done really well here. Taking some of that off the table and reallocating it makes a lot of sense to bank some of that profit. And what we've looked at is whether we can maintain the overall expected return of the investment strategy by taking some money out of equities and reallocating it towards income assets that are still generating a reasonably high level of return. And what we found is that by reducing the equities a little bit and reallocating that to property and infrastructure and natural capital, we can diversify our investment strategy so that in the event that equity markets do take a pause and perhaps fall a little bit, we are more protected because we're not so exposed to those asset classes, but the return is maintained because we're reallocating to things that are still expected to deliver a return, but in a slightly different way to equity markets. So that current target of 48%, and we're 12 or 13% overweight to that, we looked at whether that 48% was still appropriate or whether adjusting that slightly produced a better result for us. And what we found was that actually reducing it ever so slightly more gave us, again, an enhanced protection, but didn't detriment our expected return, providing we're allocating to other things that are still expected to deliver a return for us. So in the executive summary, you can see the proposed long-term strategy reduces the equity allocation by 2 percentage points from 48% to 46%. We're currently 61% allocated to equities. That's a really significant reduction. There's 600, 700 million pound reduction in our equity exposure. And doing that in a dramatic way isn't something I would recommend because you're never going to get the timing absolutely right. So what we've looked at to try and move us more towards that is an interim target to try to get to over the next few months. And that is shown again on the executive summary, that proposed interim target, still reducing the equities by a material amount. It's still by 6 percentage points, 7 percentage points. But instead of going all the way to 46%, we're recommending an interim step going down to 54%. That interim step does reduce our expected returns slightly because we cannot immediately reallocate that capital into some of the illiquid assets that we would want to. It takes time for those income assets, the infrastructure, the property. It will take time for that to have that money put in the ground and actually be invested. So that interim target does represent a slight reduction in expected return by 0.02%. I think it reduces it from 8.8 to 8.6, but it does significantly reduce the risk in the short term. And we're recommending that that reduction in equities is allocated to protection assets, liquid protection assets, so that as money needs to be drawn, when we're allocating to the infrastructure and the property, the managers that are managing that, when they find suitable investments, they will say, can we have some money to invest in these assets? We will have that money available in our protection portfolio to be able to give to those managers to be able to get that money invested. So high level, we're recommending a reduction in our growth portfolio. In the short term, we're recommending that that money gets allocated to credit-based assets in the protection portfolio. But in the medium term, that will be recycled back into income assets. And when it becomes recycled back into those income assets, that expected return will revert back to the 8.8% target return that we have. And the risk will be lower than it currently is. I'm going to pass over to Chris now, who's going to talk in a bit more detail about each of the underlying elements within the growth, the income, and the protection. And I've no doubt I will chip in because I can't help myself.
Just before Chris starts on that element, just to reinforce some of the points that Mike's made there, committee. The reallocation of some of the growth assets into income yielding assets is an important one as well, purely from an operational standpoint, in that following the 2025 triennial valuation, contribution rates across the board for all our employers are expected to reduce Therefore, cash flow from our employers will reduce, and our requirement and necessity to have real income arising from our investments will become a real necessity going forward, because for the first time we shall need that investment income to meet liabilities and pay pensions, which is the normal course of business for a pension scheme. However, historically we've been able to manage other cash flows to meet those liabilities going forward. So the point and strategy that Mike has outlined has a very important operational component to it as well. And just to reinforce Mike's point about reducing growth assets and our recent experience, the last 10 years as far as equity is concerned have been extremely positive, more positive than anyone probably could ever have envisaged. And all commentators would indicate that a correction is due, but who knows when, and now would seem to be an appropriate time to make those moves that Mike and Chris recommend in reducing those growth assets and more importantly those equity assets accordingly. Noting, as Mike indicates, we're 122% funded, and we're in that risk management phase of our investment strategy now. Managing that risk appropriately is our main objective, I would suggest, whilst we sit at 122% funding. Thanks, Chris.
Thanks, Jeff. Thanks, Mike. Thank you, Chair. It's lovely to be with you all here today. I'm just going to hop onto slide 11 on the slide deck there. So taking in turn those two key questions Mike identified at the start to look at things top down in terms of the high level mix of growth, income and protection, and then some more detail on the structure. Has that helped? Has that helped? Pardon me, I'll start again. Thank you very much, everyone. I'll take in turn those two key questions that Mike referenced in terms of that mix of growth, income and protection assets, which is the most important decision you make in terms of setting an investment strategy. And then I'll go into some of the detail within each of those buckets. So looking at slide 11, some of the things we were taking into account in this process were the fund's ambition to retain portfolio efficiency, taking the right level of risk in balance with return, and having a resilient portfolio to weather different economic environments. And also that point that Jeff's drawn out there as well in terms of recognising a changing cash flow profile for the fund and operational needs to meet member benefits. The fund is also very aware of its responsible investment ambitions and duties, and we're cognizant of how the fund might identify opportunities and risks relating to climate and nature as well. And throughout all of this, aligning with changes in the LGPS and using your options available through the pool. So if I go to slide 12, taking a step back, a reminder that that triennial valuation cycle means that some work's been done in recent years to map out the liabilities of the fund and test how the investment strategy is aligned with that. So we did some detailed liability modelling in 2023, and the investment strategy was reviewed in detail in that point, taking both into account, and some changes were made to the high-level strategy at that time, which reallocated from growth assets to income. So it's still implementing some of those changes now, and that was what Mike was drawing out in terms of taking time to work towards those. Ultimately, though, this is a testing of the appropriateness of the target strategy and making sure that it's still well aligned with your long-term investment objectives. So we've identified there that the current weight of some of the assets are are different to the current strategy targets. But primarily what we're testing here is going to be, is that target strategy appropriate? And we'll come on to the sort of practical implementation elements of that in a second point. So just starting with that first key element on the next slide, let's take a look at that current target strategy. And we modeled a range of alternative investment portfolios, each with different tweaks to the balance of the asset classes. And that's done with our model that takes into account how we expect asset classes to perform over time, but also perform in relation to each other. So taking account of that sort of diversification element between the two. We've identified that the most attractive option across that set was alternative 2, which we've shown on the screen here on the right-hand side of the column. And as Mike mentioned there, it's a small change compared to the target strategy in terms of bringing the allocation to global equities down by 2%, recognizing that there's been growth in that market and potentially some pressures in the equity market, and reallocating that balance to natural capital to continue to benefit from the, to continue to diversify within the income portfolio and add resilience through the allocation to bonds to increase that protection part of the portfolio as well. So yeah, moving away from where there's maybe pressure in markets towards building in more diversification, that resilience, that efficiency element, and also building up some more sort of protection defensive assets as well. So our primary recommendation there is to adopt that alternative 2 as the new target allocation. We tested this, and the rationale for it primarily is that when we compare the target level of return between the current and that new proposed target, the return level is pretty much the same. It's just adding things that in the modeling we can't draw out in the same way. That element of you have a bit more flexibility and you are leaning on your pool options, that doesn't come through in the model numbers. The risk values improve from around 13.3% to 13.1%, which recognises a slight efficiency in terms of the amount of risk you're taking to get a certain level of return. So that we see as a beneficial step, a very small evolution on what is already a very appropriate current target strategy that you've got at the moment. I'll pause there if there are any questions before I step on to the next slide.
Yes, I have a question. You indicated that during the next couple of months that you're going to disinvest from equities about 6% in the next couple of months. What's the timescale for the complete transition of equities to income and protection? Can you give me some indication of that?
Yeah, that segues me onto the next section, but I'll answer it very briefly. We'd recommend that those changes are implemented by the end of this quarter. We can work with our transitions team to recommend how to space those kind of changes, but largely we think that you can put that into place in line with the interim target, and I'll touch on that on the next slide, by the end of this quarter. And there are some elements that I'll pick up through the next couple of slides that will bring that to life a bit more as well.
Thank you. Sorry, Mike, didn't see you there. Thank you.
Yeah, Will has got his hand up.
I will say it again. What is private credit, which you're going to increase from 2% to 5%?
So private credit is if you think of a bank making a loan to a company after the global financial crisis, there were some regulatory changes that in essence meant that banks were no longer able to make so much of to perform that role in the same way. But there's still a great need for it. Companies still need that capital to invest, build their companies, and that sort of thing. So there is that need for it, and investors like the pension fund can perform that role quite comfortably. It's essentially like you would invest in a bond to, say, Google, which you'll be familiar with and would trade on listed markets. It's just these are maybe to smaller companies that aren't, say, household names or aren't traded as frequently, hence the private element. What we're not doing here, though, is suggesting a change to that allocation. I'd draw attention just to the 2 columns on the right of that slide, which are the comparison between the current target and the alternative, which is 5% for both. That allocation was introduced over the past 2 or 3 years, and it's just taking a bit of time for that allocation to build up. So the fund has made commitments to that asset class through WPP, and that's just building over time. Is that okay?
Yes, thank you.
Thank you, Mike. Can I now bring in Councillor Will Thomas? Will.
Thanks, Chair. I've got a few questions, but just one specifically on what we were covering there, the sort of divestment into private credit bonds. And I was literally reading an article yesterday, the day before, I can't remember, from Ray Dalio, talking about the sort of debt spiral, the debt spiral the West's going through, and basically don't touch bonds. And we're looking at moving quite heavily into bonds, and I would think Ray Dalio knows what he's talking about. So I just want to understand if you're familiar with that strategy and his opinion on that, how yours differs, please.
Yeah, I think one of the main things to mention, I'll pass on to Mike briefly and see if there's any comments to add. But I think the main thing to bear in mind with bonds is that they are what we consider the first claim for an investor on a company. So if, say, a company goes into default, the first people who have a claim on the assets of that company are ultimately bondholders, and it's equity holders who bear higher risk, and they're the last that get to claim anything there. So bonds are considered significantly lower risk than equities, and if there are changes in market conditions, it's typically equity markets that are much more volatile. I suspect the changing conditions that some market commentators speak to there is maybe in terms of government bond debt burdens, that sort of thing, and whether certain companies are taking on more debt than they can service over time. We've not recommended allocating more to government bonds here, but bonds generally do tend to be linked to the yields of government bonds, so that's worth bearing in mind. But broadly, in terms of how we look at the risks and returns of bonds, they're still one of the lowest risk assets, but at the moment they're able to generate a higher return for that. I'll just check if you want to add anything there, Mike.
Yeah, well, I hear what you're saying. I think Ray Dalio is, a very skilled investor, and he makes some compelling arguments as to why the indebtedness of governments, particularly the US, could result in the next debt crisis. I think what we are recommending here, as Chris said, we're not recommending an allocation to government bonds. The two areas where we would park the proceeds from the equity sales are global credit and absolute return bonds. And so both of those areas, one of them is more manager skill based, but both of them are very short dated bonds. So they repay the capital that's been lent to those companies in relatively short order. Government bond markets are much longer dated, and so you've got a much longer period of time where you're waiting for that money to be repaid, and during that time there's risk that global events happen, and that affects the probability that you might be repaid. So I think what we're recommending in terms of allocating it into the bond area of protection is a very short dated bond. and I think it's a very secure area, more secure than the areas that Ray Dalio is speaking to.
Thanks. If I could just come back on that, Chair, if I may. Yeah, I think that is exactly the point. The inflation outlook over the long term, not necessarily government, but in general. So that's good to hear. Thank you.
Thank you, Will.
Thanks very much. So I'll hop on to slide 14 with all that in mind.
Hang on. I wanted to ask a question as well. I think the chair's actually missed my hand up.
Sorry, Jeff. Sorry,
That's
Jeff.
okay. It's Jeff Jones. I'm very new to this committee, so excuse my perhaps ignorance. You seem to have a great feeling that the equity market is going to go through a change, shall we say? A reduction, and moving into a safer area. I think the first meeting actually came to. You actually said moving into a safer area gives you a lower return anyway. You've got safer investment, a lower return. What sort of difference in return would that be? And if I can refer as well to Jeff Dong, he actually mentioned something about reduction in contributions. So, is the fund actually going through a change where the contributions to the fund from, shall we say, members are going to be reduced?
I think that's it.
Do you want me to address the last bit first? Sorry, Chris. My colleague Chris will come into technical aspects of the question, Councillor Jones. In respect of members' contributions, 2025 is a triennial evaluation year. The appointed actuary analyses all the pension promises the fund makes to its members, calculates those pension promises, and comes up with an answer in respect of the pension fund's liabilities. He throws that against what the pension fund owns in terms of assets, and that indicates the funding level that has been referenced a number of times by Mike and by both Mikes actually today. And we're very healthily funded at 122%. And as a result of that, Councillor Jones, the actuary has determined that the contribution rate that employers pay, because that's the important thing, employers' contribution rates are variable. LGPS members' contribution rates are fixed according to the salary that they earn. However, employers' rates are variable, determined by a triennial evaluation every 3 years, and as determined by the appointed actuary. So you're quite right. Following the 2025 valuation, the appointed actuary, Aon, have recommended to this committee that employers across the board reduce their contribution rates to reflect that healthy funding position. And in concert, that speaks and is consistent with the investment strategy you have before you, in that because of that healthy position, because of that overfunding position that we've got at the moment, it is appropriate that the fund notionally de-risks and, to your point, reallocates assets from riskier assets, i.e. equities, into more income-bearing or protection assets that, as recommended by our investment consultants today, and that is consistent with that position of reduced contribution rates and an overfunding position experienced by the fund. And yet you're quite right, Councillor Jones, that equities are expected to give a higher return over the long term than these other asset classes that we're recommending. But importantly, we're looking at a whole portfolio approach, and we're looking at the combined return of the fund, not different elements of them separately. Mike and Chris have recommended and built a portfolio which generates a whole portfolio return which is appropriate for the fund, and it's the skill in mixing the different risk profiles of those different asset classes that we pay Hymans for their expertise in modelling those outcomes to give us the recommended strategy mix that we've got before you. But your observations about the different return profiles of the different asset classes are wholly accurate and quite right to bring them to our attention. But it's how they work together on a total portfolio basis that we're looking for the committee to appreciate and approve today.
Thanks, Jeff, and thanks, Councillor Jones, for the question. I think the only thing I would just observe is that we're not calling the top of the equity market at all. I'm not saying that there's going to be a sudden correction, but I am saying that we've been heavily allocated to equities, and we will continue to be heavily allocated to equities, but reducing it from 60% to a little under 50% is just prudent risk management given the performance of equity markets that we've enjoyed. So we're still going to be very reliant on equity markets, and we still hope that they will continue to outperform for us. And over the next 10 plus years, we're a very long-term investor. We would expect that to deliver for us. But given the funding position that we enjoy, and given the income needs that we now have to pay benefits, we're going to be cash flow negative. So the income that we're receiving from contributions is going to become less than what we're paying out to pensioners on a monthly basis. Given those things, reallocating some of the investments from equities into income generating assets is a prudent and sensible thing to do given where we are. And we've tried to structure the income assets in a way that it doesn't detriment the overall total portfolio return. Okay.
Is that all right, Jeff?
Yes, it answers some of it. You know, the contributions element, you know, worried me on the reduction really in returns on investment, you know, how that would affect the fund at the end of the day. But I think we've got an assurance really that the difference will be negligible. I'd like to get a figure out of it, but I don't think we can really at the moment.
We've got the expected return figures on page, and I'm going to look at Chris.
I don't think we've got them detailed here, but I think our expected return on equities at the moment is around 8.6%. But it's worth bearing in mind that while over long periods of time, equity markets are expected to return or have returned 8 to 10%, they very rarely do exactly within that band. So that's why we build that sort of modelling to take a medium-term view, to recognise that element that over a sustained period of time, equities should generate a bit of return, but will carry higher risk. And when you mix that in with the other assets in the portfolio, you take a sensible approach.
So Jeff,
Thank you, Chris.
If you look at page 14, there's a table of numbers there, and the third line from the bottom is the return expectation of that total portfolio. And the current allocation, where we've got 70% in growth, the expected return is 8.8% per annum. The interim target, where we reduce the equities by 7 percentage points, does reduce the expected return from 8.8 to 8.6. But when we then reallocate to the new target, which is even less in equities, but more into the property, the infrastructure, the natural capital, that actually returns the return to the 8.8, 8.9%, because we're reallocating back into things that we expect to deliver those returns.
Okay, thanks very much anyway.
And sorry, Chairman, just as well, Councillor Jones was asking about figures. It reads in conjunction with the valuation certification as well, Chairman, and the actuary in their calculations about fund expected returns, because as part of the triennial valuation, they do appraise and review the investment strategy implemented. So the discount rate that they've applied during their evaluation is the lowest discount rate. I'm not incorrect in saying amongst all the Welsh LGPS in respect of the expected investment return that they've signed off and certified for their valuation. So this return that Mike and Chris are recommending is far in excess of that required notional investment return as certified by the investment actuary, by the appointed actuary.
Thank you, Jeff.
And that's 4.125.
Thank you for that information. Carry on. Chris, do you want to carry on?
Yeah, thank you. So if I look at slide 14, we start to think about what this all looks like in practice. So how might we over Q1 by 1st of April move from where the portfolio is now towards that proposed new target that we've set out there? What we can't do is move in and out of private markets over the next week. We have to assume that those private equity property infrastructure allocations are somewhat fixed. But what we can do is make sure that the liquid assets, which are in equities and bonds, are managed in a way that are allow you to be available to meet cash flow needs and any allocations to property or other investments that take time to draw. So looking at the chart on the right, we've got columns that say current actual and the alternative to proposed target on the right. And the midway, what we've proposed here is a step halfway between the two by changing those liquid assets in equities and bonds. So in practice, working towards an interim target of 54% in listed equities from 61 at present, and moving towards a target of 17% in listed bonds from 10%. And that basically says that of those assets that are going to be invested in income assets, they'll be split evenly between equities and bonds. And the purpose of that is that resilience point. That means that if markets are unfavorable in the next couple of years, you have plenty of assets held in high quality bonds available to meet that. You would not be a what's referred to as a sort of forced seller of equities to meet capital requirements. So our recommendation there is to take a pragmatic approach and define this sort of interim target and work towards that over Q1. And that still requires some disinvestment from listed equities in the next few weeks. I'll pause again there for some questions, but some of these bits we've touched on from some questions, but I hope that gives some clarity to it.
Thank you, Chris. Any questions for Chris on the last item?
Super. Okay.
Carry on, Chris.
We've got a super amount of time for this, but I am conscious that I don't want to exceed that. So I might rattle through some of the following slides a bit more quickly. So if I flick through to slide 16, we have gone through each of these buckets, the growth, the income and the protection portfolios in detail and had a look at what sits within each one. Crucially, within the growth portfolio, we're not recommending any changes in the near term. We're comfortable with the mix of assets in that portfolio, and you're well aligned with what the pool delivers, and those solutions are cognizant of climate, biodiversity risks, that sort of thing. One area where there is potential for change in, say, Q2 or Q3 later in the year is that there is one option that's available through the pool, through emerging market equities, where you're currently investing with BlackRock. That's something you could potentially look at, but it's not a recommendation today. It's a potential piece of work for later on if it was something that you felt was pressing. Going through to the income portfolio, that's where there was a little more change in terms of the target allocation, bearing in mind that earlier we discussed a small change to natural capital. But also there are new solutions available through the pool for property. So I'll just go through those two in a bit more detail. Firstly, on slide 19, we look at the property portfolio, and currently the fund's invested across residential investment, a new local allocation through Newcall, and also in UK commercial property. The pool will be introducing solutions for yourselves and partner funds to invest across UK commercial property, local property, and global property. So it makes sense to start to align to those categories. We're not recommending drastic changes to what you've already got or to sell things in the near term, but setting a long-term target, which is based on ranges to allow a bit of flexibility around those, given not all of those solutions are available. Setting some long-term ranges around those is a sensible step, and we've set out some proposed long-term targets there in terms of using UK property as a core of the portfolio, so working towards a 4 to 6% allocation there, investing locally in property up to 3% and globally up to 3%. But ultimately, not changing your total allocation to property, which was 10% before and remains. We recommend stays 10%.
Question from Thomas.
Will, good question.
Yeah, thanks, Chair. Obviously, we've been looking at investing locally in residential property, and we've had some success with some schemes, which is great because obviously it gives us some fairly good returns, and we help the local housing demand and needs there. So I think everyone on the committee is keen to do as much of that as we can. First question is, how do those our current investments perform return-wise against, for example, the UK property fund? So if they're similar, I know obviously these schemes that we invest in locally aren't always forthcoming. It's like hard to find ones that stack up, but if you could answer that question, and then if they're similar, I would say let's do more of that locally. And my second question is with regards to commercial property. Obviously, offices are not quite as desirable, I suppose, as investment as they were in the past. So commercial property, if that is that office blocks, is that offices? Are we thinking, is everyone going to go back to the office, or are we just going to be holding the can when the whole commercial property market collapses and no one wants to rent offices anymore? They're my questions on that one. Thanks.
Yeah, I was going to say, Jeff, can you take that?
Thanks, Councillor Thomas, and you're quite right that this investment strategy here is very much written and formulated in light of fit for the future's asset allocation buckets at a high level. But you're quite right in that fit for the future does require funds to indicate a local investment objective, and this committee will consider more detailed considerations in respect of that, because they will form a subset, because local investment could be either infrastructure. Well, in our experience, it takes the form of infrastructure, it takes the form of affordable housing, it takes the form of social infrastructure, for example. So they can't be neatly bucketed, within the asset classes. They sort of permeate through those different asset classes that Chris and Mike have talked about. But directly to your question about our local experience, as you're aware, the New Core Capital partnership, the Swansea social partnership that was established last year, that's very much in the deployment phase as we speak. I had an update from the manager last week with some of the assets that are populating the pipeline now, that they've deployed £12 million worth out of the 50 million the fund's total value is. Number of medical centres, doctor surgeries that they're repurposing and consolidating for the local health board. And there's a affordable housing development bang in the centre of Swansea city centre that you'll be aware of, that's currently in development. So hopefully within the next quarter or so, we'll be able to get new call down to give committee members an updated presentation on the pipeline which has been deployed, but also the pipeline that they're looking to deploy in the coming months and years. In terms of expected return, obviously at a total portfolio level, that fund is looking at a 10% IRR. I've heard nothing from Hugo or the investment manager themselves, Harry, who's on the ground, to indicate that that's not achievable based on those assets that have already been deployed. So good news on that front. And I think officers and the committee echo your sentiment that we'd like to do more. And obviously, one of the objectives of WPP IMCO's business case, which was approved by the government, was the local investment piece and increasing and improving that capability to invest within Wales, not only in Swansea, but the rest of Wales as well. And hopefully from April 2026, we'll be pressing the new WPP investment management company hard on identifying more opportunities for us to invest locally. Commercial and other property return profiles and opportunities. I'll hand over to Chris and Mike.
I'll just touch quickly on it, Will. I think commercial property for us isn't just offices at all. It covers industrial buildings, it covers retail, it covers distribution warehouses, and ultimately it would be for the manager to choose which assets they were that they were holding. Having said that, once you own assets, it's not always easy to reallocate quickly. If you foresee offices, for example, in a cyclical downturn and you want to be underexposed to them, that's probably too late for you to start reallocating your portfolio. But we're looking to allocate more to property, and that will give the WPP manager the opportunity to allocate into areas that they expect to be delivering good returns over the next decade.
And just to add to that, we had a visit, Jeff and I, to a data centre in Newport a couple of months ago, which we have invested in, which was an absolutely ginormous building, but given us a very, very good return. So infrastructure and building is not off the table. It's just directing where we invest. Thank you. Chris, do you want to carry on?
Thanks very much. I'll skip on to slide 20, just to make a point that we've recommended an increase to the long-term target to natural capital from 5% to 6%. And the fund has already made commitments to timberland assets, that sort of thing. To date, once that's fully drawn, because these are recently made commitments, that will be at around 4.6%. There's a little bit of room there to make further commitments, and our recommendation is to wait until the solution is available through WPP and communicate your expectations with them. And once a solution is available, commence that work to make that to bring that up to the proposed target. Another key element I wanted to cover here as well is on slide 23. So that's looking at the protection portfolio, which is largely consisted of those bonds. It's that resilience part of the portfolio. Currently or previously, you the fund has a target to invest around global bonds, absolute return bonds, and trade finance, and trade finance is sort of helping those short-term cash flow needs that companies have over a couple of months. So similarly, credit-based and allocating to largely companies, and finally to UK government bonds, around 1%. Considering how WPP as their solutions are available, and that alignment over time to invest through those, our recommendation here is to make a new allocation to global credit, which is a high quality sort of investment grade and highly diversified global bond fund. That would be a new allocation for the fund. So there's a follow-up piece of work that we'll be working with the committee on in terms of assessing the suitability of that fund, but that's not a decision for today. Retaining the absolute return bond fund allocation, and over time transitioning the assets that are in solutions of that sort into the WPP absolute return bond fund. And where there's a collection of other assets like trade finance and gilts, we don't think that it's necessary to sell those in the next couple of months and reinvest them elsewhere. That could incur transaction costs, operational risks, that sort of thing. Over time, we think that's a reasonable source to draw cash flow needs, and we're comfortable to have a broader other protection allocation to recognise that there are some legacy non-pool aligned solutions there. So in terms of what's implementable over the next couple of weeks up to the end of this quarter, what can be done is to assess that new WPP Global Credit Fund, to reinvest sale proceeds from elsewhere in the portfolio into these new solutions, and reduce that trade finance allocation and recognise it as an other protection allocation. So the key point here is that, bearing in mind those discussions earlier, a target allocation before was around 12%, and we recommend moving to 13% and recognising the breakdown of these assets in a way that's well aligned with what the pool can deliver for you. I'll just check if there are any questions there as well.
No, I don't see anybody indicating, so can you carry on, Chris?
So there's quite a lot to take in here. There's a number of recommendations and a number of actions over different periods of time, and we've tried to summarize all of the actions that are coming up in slides 7 and 8. So if we just quickly look at slide 7, these are the short-term actions that will get us to the interim target, and we've listed on the right-hand side of this slide the trades required and the amounts of money involved for the equity sales and the other adjustments within the protection portfolio that Chris mentioned, the trade finance reductions, and the increase in the protection assets allocating to both WPP Absolute Return Bond Fund and the WPP Global Credit Fund. So they are relatively material amounts of transactions. We're selling £380 million of equities and trade finance assets, and we're buying £380 million of protection assets. And those are actions that we would look to take over the course of March. On the next slide, slide 8, there are a number of other actions and timelines. So for example, we talked about allocating away from the BlackRock Emerging Market Equity Fund and allocating that to the WPP Emerging Market Equity Fund, and we're suggesting that might take place in the second quarter. It's not urgent. It might slip into later quarters given other bandwidth that we might have, but that is something that we see happening over the course of 2026. And then the allocations that we're making to infrastructure and to property they will come over the course of the next 18 months. Bring us in at exactly 11 o'clock, Chair. And back to see whether there is any disagreement with the decisions that we need.
Any other questions to our advisors? Oh, Will, thank you. Sorry, wrong glasses I got on. Will. Carry on. Thanks.
No problem. Thanks. And obviously at one of the previous meetings, the committee asked you, the committee is probably a bit strong, I asked you to look into Bitcoin and gold as other allocation potentials. I just want to give a little bit of background for the record on why. I mean, I see the end of globalization, the world sort of breaking apart, and all these sort of the international order as we know it is fracturing, and where that goes after that is anyone's guess, really. And I think gold, and certainly in the modern era, Bitcoin are there's no counterparty risk, so there's strategic hedges against that sort of new world and what's gonna come out of it. So I thank you for looking into them. I see on Bitcoin you recommended that it was that the fund doesn't take up an allocation. I think when our grandchildren look back at this video, they'll have a giggle, I'm sure, and wish we had. But I do understand the predicament that sort of the pension fund is in when it wants to look at things like this, because I do understand it's hard. But from my personal point of view, it's a great hedge. It's very good for the environment, although there's been lots of hit pieces against it. But if people look into it, they'll find a different story. And it's very liquid, as we're seeing at the moment with a little bit of a downturn. But Bitcoin aside, when we look at gold, I looked at the appendix on page number, bear with me, sorry, 1 second.
33, yeah.
33, thanks. And I couldn't really see the opinion on gold. It's sort of a strategic role, but it doesn't really form part of it doesn't really say what the opinion is on gold. I mean, myself and the chair were quite keen to allocate to gold, a number of years ago, which we then decided against also. But to the reasons that I've mentioned previously. So my question, I guess, is I can't see anywhere in here which sort of suggests we don't allocate in gold, but I can't see anywhere that says we do. And the strategic role of gold seems quite positive on the appendix, but there's no allocation. Maybe I've missed something. Thanks.
Yeah, I'll take this. So Will, I guess at the moment we're not recommending a strategic asset allocation to gold. When you look at the history of gold, it has had incredibly long periods of time where it hasn't done anything at all, really, and then it's had short bursts where it's performed incredibly strongly, and that is definitely the case. That is what we have seen over the past year or more with gold, and gold has gone, parabolic almost in terms of the increase that we've seen. And sorry, I don't have the last few days of the gold price, but it's certainly above $5,000 now. I think that leads me to be particularly cautious about an allocation to gold at the current time. So tactically, I definitely don't think now is the time to be allocating, but strategically, it gives you some diversification, but the return expectation of gold is virtually impossible to divine. You just don't know what return delivery you can put on it because it doesn't deliver an income. There are custody issues with holding the physical form of gold. We do have exposure to gold through the mining companies that we own through equities, but I do accept it's not a direct allocation to gold and a spot price. I wouldn't ever put gold as a standalone strategic asset allocation, but I would be open to a conversation about a commodity allocation, and through the commodity allocation having an exposure to gold. I think that's probably something to take away and just think about how we could structure that. And I'd also want to think about that, particularly in the context of the Fit for the Future consultation and WPP, and whether, you know, what offerings there might be for that from the pool. So, Will, I guess the answer to the question is we're not recommending a strategic allocation to gold, and I would struggle to have it as a standalone allocation.
What's your feelings on that, Will?
Thanks for letting me come back in, Chair. Yeah, I mean, I understand I understand your point of view. However, you know, we looked at, I think me and the Chair brought this up, a gold as strategic allocation at when it was like $1,000 an ounce. So, you know, that wasn't a good time either, because gold doesn't pay a dividend, yet it's gone up 500%, you know. So I think it is money. And, you know, I think commodities, again, the world's going into a place where things are going to be priced in commodities and not in paper, I think. So I think that is a good positive move forward if we can look at a commodities allocation. Just one last point, if I may, regarding back to Bitcoin again. If BlackRock, which is the biggest asset manager in the world, and the US government are also looking at strategic Bitcoin allocations, why is it such a stretch for for us and the WPP? And that's me done then. Thanks, Chair.
Thank you, Will.
I mean, I think we've tried to set out on page 32 the various arguments as to why we might be supportive or not supportive. And I think the volatility of it and the putting a mathematical value around what it should be worth and what it should expect to return and how it could be correlated with all the other assets that we hold is an incredibly difficult thing for an institutional investor. And I'm not saying that it's not a good investment for individuals, and individuals you know have their own risk tolerances and their own objectives, but for us it's very difficult to see how it supports the objectives and how we can mathematically model how it supports the delivery of the objectives that we have as a pension fund. So for that reason, it's very difficult to have an institutional strategic allocation to it. I know that's not the answer you want, Will.
Thanks for that, Mike. Yes, carry on.
Like I said, our grandchildren will judge us.
Indeed.
We seem to have this conversation every time we have a meeting, Will, but there we are. I think that's a very good answer from Mike. As an institutional investor, we should not stay away from it, but try and avoid it at the moment. But is that all from you, Chris, or are you going to carry on?
Yes, thank you, Chair. There was, I think, maybe one other question the other side of the room there.
Sorry, Mike, I kept missing you. Keeping on my left there. Yes, carry on.
Right. Yeah, regarding gold, isn't gold linked to the US dollar? So if the US dollar is going to be in long-term decline, I'm not saying it is going to be in long-term decline, but that would indicate that gold will go up. But my main question is about offices. What is the market in investing in offices in the UK? Because some parts of the country seem quite so poor, but then in London, there's an actual shortage of space. So that is my question.
Yeah, I mean, absolutely right. There are different parts of the market, and in offices particularly, there's definitely a shortage of prime grade A office space. And across the rest of the country, there is a surfeit of poor quality office space that is going to require enormous investment to bring it up to environmental standards by 2030, which is a legal requirement. So if you were allocating new money to commercial property, you would want a manager who was being very careful about how they were allocating it. We already hold some commercial property, and that has a range of offices. I think most of it is southeast based. So I think the offices we hold are in those better parts of the country. What I would say is that everything has a price, and a good manager ought to be able to make a return, providing they pay the right price for the asset in the first place.
Thank you. Would you like to carry on, Chris? Or?
It's a recommendation.
It's you finished. If you,
Yeah.
Thank you. Thank you. Yes, there's a recommendation to approve the recommendations and implementation actions contained in the report. Could we go to a vote on that, please, Charlie?
Yeah, those for the recommendation, please show. Okay, and those against? And any abstentions? Okay, thank you. That's carried. Thank you, Chair.
Thank you, Chairman. Just an additional comment re property for Councillor Locke. Obviously, it's the age-old adage of location, isn't it? For property investment is concerned, and Mike is right. That is very much location based. Obviously, within the Swansea portfolio as well, we've got a European property exposure as well, and that is largely concentrated on office exposure in the prime commercial business district. They very much concentrate on the prime commercial business district of the main cities within Europe, like the main CBD areas of Paris, Munich, etc. All the main commercial centres. So it is, as Mike indicated, very much location dependent on that demand for office space. And as we're seeing now, Councillor Locke, more and more big corporates are demanding that their workforce go back to the office on a at least 4-day-a-week basis now. So I know Chris has recently relocated to London recently, and I'm sure they're making him go into the office more regularly than he would like. Yeah, there is slowly going back to a normal office-based work environment, slowly but surely, I think. Thank you, Chairman. Agenda item 4. Funding strategy statement. Those eagle-eyed amongst you will recall why are we receiving this again? Because we only had this report in November. Well, committee members had the draft version of this funding strategy statement for your approval in November, and committee very kindly approved the draft version of the funding strategy statement, with a view to then taking that draft and consulting with all 26, or is it 27 now that we've got Mrs. Bucket Cleaning Services as well. I think it's growing by the day with these additional cleaning services that we admit as employers within the scheme. But we were required to consult with oral employers on this document that you've got before you. And I'm pleased to say that we didn't receive any contra comments or contra opinions in respect of the document that you've got before you. So I'm now required to bring the final version of this document, and I can confirm that it's exactly the same as the draft version of the document that you received in November for your formal approval, so that the actuary can implement this funding strategy statement when they sign off their valuation certificate at next month's committee meeting. Chairman, the recommendation is on page 40.
Yes, the recommendation is that Pension Fund Committee approve and funding strategy statement for 2025 following consultation response from employers. Can I have a vote on that, please, Jeremy?
Those for the recommendation? Okay, any against? And any abstentions? No, okay, that's carried. Thank you, Chair.
Thank you, Jeremy. Moving on to item 5, which is the training strategy. Again, I hand over to Jeff for this.
Thank you, Chairman. And the annual report that comes to committee outlining and reminding members of this committee and also importantly the local pension board. I know we've got Ian Guy on the line, who's chair of the local pension board as well. It's a legal requirement, a legal responsibility on all members of the committee and the local pension board to ensure that they have the appropriate knowledge and skills with which they discharge their roles. And then it's incumbent on us as the admin authority, the scheme manager, to provide you with that knowledge and skills and training that you require and support you in ensuring that you have the appropriate tools so that you can do your job properly. As such, you know, and it's quite prescient as well because we've got 2 relatively new members of the committee. You know, Councillor Jeff Jones has indicated that he is relatively new to the committee, and we've got Councillor Pritchard as well. And I know Councillor Pritchard has recently undergone his introductory LGA training, which is also always lays the groundwork for trustees' knowledge and skills training, which is an ongoing process throughout their tenure on the committee and board. You know, we arrange in-house training here, whereby our managers and our professional colleagues provide training in-house here, but also with the advent of online learning, our partners at WPP also arrange a lot of training and educational pieces that members are invited to throughout the year. So the report you got before you, Chairman, is just you know, it's a gentle reminder to committee members and board members that when Karen sends you an email inviting you to some training, that it's you know, incumbent upon you to attend if you can possibly do so, because there's a requirement of your role in this committee. And we've identified some training within the report there for the forthcoming year. Also, it covers training required of officers who provide advice to you. Like my colleague alongside me, the investment and pension fund manager, Karen Cobb, my colleagues on the admin section, Claire Elliott and Nick Jenkins, they will all undertake professional training throughout the year. And this training strategy, although it's entitled trustee training, it covers all the training that is required of officers and elected members in discharging their duties to the pension scheme. Happy to leave it at that, Chairman. The recommendations on page 83. Oh, sorry, Chairman. There was a correction. I outlined within the report in paragraph 23. I think it was paragraph 20. Sorry. Yes, at paragraph 23, a correction needs to be made. I erroneously included the training that was received in the prior financial year. The current financial year's training received by elected members has been circulated in the revised copy of the report that I circulated by email late yesterday evening. So if that could be noted, Chairman, that paragraph 23 needs to be amended for the report that I recirculated yesterday, Chairman. But the recommendation is, as I say, on page 83.
Thank you, Jeff. Yes, I did receive that by email and read it. Okay. the assessment and outline training plan in section 24 to be approved, and further opportunities which should be identified during the year be delegated to the Deputy 151 officer and implemented and improved for approval. So, Jeremy, can we have a vote on that?
Okay, those in favour of the recommendation? Okay, I can't see your hand, Willie. Is that a...
I'm not a.
Oh, sorry, you're not on this. Sorry. Sorry. That's unanimous, Chair. Thank you very much.
Thank you, Jeremy. Right. Moving on to item 6 on the agenda, which is the Wales Pension Partnership Investment Management Company, Local Government Pension Scheme, LGF Fit for the Future governance documents. So can I just ask Jeff to come in here and give us an update? Thank you.
Thank you, Chairman. Primarily, this is the reason why the Special Pension Fund Committee was called, Chairman, to approve this report and the documents attached to this report, and a number of other documents in the next section of the agenda. In short, we're asking this committee to approve this amendment at this item, an amendment to the current inter-authority agreement. And the inter-authority agreement is the legal glue, the legal document which holds together the 8 Welsh local government pension schemes in a collaborative endeavour, which since 2017 has been known as the Wales Pension Partnership. And this report is asking committees, not only this committee, but all the other 7 administering authorities are going through a similar process. Some this week, some have already approved this report. I think Carmarthenshire, Powys and Torfaen have already taken this report to their committees and they've already approved it. So we're all working consistently in asking our committees to approve this new governance document, which sets out how we, as collective 8 Welsh pension funds, work together. Largely, this inter-authority agreement outlines the governance arrangements which are in place, you know, the joint governance committee, etc., the officer working group, how regularly those group meet, and their terms of reference. This report that you've got before you has been largely scrutinised by professional officers and legal monitoring officers from the 8 administering officers, including Debbie Smith, the Deputy Chief Legal Officer, sitting alongside me here. But also importantly, we've procured and commissioned independent legal advice, who are advising WPP collectively, but also Swansea as a client underlying that arrangement, and you can see their advisory note attached as appendix to this report. Why has the inter-authority agreement had to be amended? Well, in light of Fit for the Future changes, Mike and Chris have indicated that operationally, come 1st of April 2026, the newly established investment management company will be responsible for managing 100% of the assets of all underlying constituent authorities in Wales. So all of Swansea's assets from the 1st of April will be managed by the investment management company. Therefore, some of the terms and references and responsibilities as outlined within the inter-authority agreement for the Joint Governance Committee no longer apply, because some of those responsibilities shall now be taken over by the investment management company. So it was deemed appropriate to amend and update the inter-authority agreement to reflect those subtle differences, and also to change the scope and terms of reference of the inter-authority agreement, in that it will largely now dictate and outline how the 8 Welsh constituent authorities shall work collaboratively and collectively as clients of that investment management company, and how they can formulate and establish voting policies, responsible investment policies collectively, which they can take and consult with the investment management company so they can implement those on their behalf on a collective basis. So the summary note that Burgess Salmon have produced is on page 103, which outlines on a line-by-line basis the changes from the current inter-authority agreement. I'm not proposing to go through that in detail. And then in detail, from page 107 is included the actual inter-authority agreement that we're asking elected members to approve from 107 onwards. And then also helpfully as well, we've commissioned our advisors, well, WPP's advisors, Hyman Robertson, who are colleagues of Mike and Chris, but completely separate and segregated to the service delivery that Mike and Chris deliver to us. They've also provided an independent assurance note, and that is on page 97, whereby they've outlined what I've tried to do so just verbally now, the reasons and the necessity for this change in the inter-authority agreement. And that largely gives you pictorially where that IIA sits and what it's looking to achieve in respect to the governance arrangements going forward. That it's quite a useful aid memoir for elected members to understand the new governance arrangements as we move forward from the 1st of April, and that's on, as I say, on page 97. Happy to take any questions, Chairman.
Are there any pertinent questions for Jeff on this item? No. Okay, I'll move on to the vote. There we are. It's recommended that the Pension Fund Committee approves the updates of the inter-authority agreement and subsequent recommendation to full council on March 25th, 2026 for approval. Can we just take a vote on that, Jeff?
Yeah. Everybody in favour, please show. Okay, thank you. That's unanimous and carried. Thank you, Chair.
Thank you, Jeremy.
So, sorry, Chairman. Thanks for confirming that vote and approval. Just to elaborate, this report is required to be then taken forward to council for approval on the 25th of March. So it's now got Pension Fund Committee approval, and so the report that will go to full council on the 25th of March will include the recommendation from this committee to approve it. But however, for legal reasons, the inter-authority agreement needs full council approval, and that will get full council approval, hopefully, fingers crossed, on the 25th of March.
Thank you, Jeff. Great, and thank you for your sorry. Right, moving on to item 7, which is exclusion of the public. Can we have a vote on that, please, Jeremy?
Yeah, thank you, Chair. Can somebody please move public be excluded? Yeah, and a seconder. Okay, all in favour?
Thank you.
Thank you. That's carried. Bear with me. I shall stop the recording. Okay,